Integrating new technologies into existing financial systems presents various technical challenges, requiring innovative solutions and careful management. As financial institutions aim to implement more sophisticated technologies like open banking platforms, blockchain, or advanced data analytics, they often face hurdles that impede progress and affect service delivery. These challenges are not only technical, but also impact business operations and customer experience. Section 1. Technical challenges. Compatibility with legacy systems. One of the main technological difficulties in integrating new financial technologies is compatibility with legacy systems. Many banks and financial institutions operate on platforms developed decades ago. These systems, while robust and secure, were not designed to interact with the newer, more agile technologies that characterize today's financial tech landscape. Integration complexity. Integrating new technologies with legacy systems involves addressing differences in data formats, communication protocols, and processing capabilities. Cost and resources. Financial institutions must allocate significant budgets for software development, system upgrades, and staff training, which can strain resources, especially for smaller banks. Scalability issues. The scalability of new technologies poses another significant challenge. Financial services must handle incredibly high volumes of transactions and data while maintaining speed and reliability. As services expand and more users come online, systems must scale accordingly. This scaling must be seamless and efficient to avoid service outages or slowdowns that can frustrate consumers and cause a decline in confidence. Cloud solutions. Moving services to cloud platforms offers flexibility and scalability, but introduces concerns about security and data sovereignty. Financial institutions must ensure that their cloud solutions meet regulatory requirements and provide robust security measures to protect sensitive data. Performance optimization. Scaling systems effectively requires ongoing performance optimization and capacity planning. Encryption and authentication. Advanced encryption methods and secure authentication protocols are essential to protect data in transit and at rest. Financial institutions must implement multi-factor authentication, MFA, and continuous monitoring for potential threats to ensure data security. Implementation disruptions. The integration process itself can disrupt existing services. Implementing new technologies while ensuring day-to-day operations continue smoothly is a delicate balancing act. It involves detailed risk assessments, phased rollouts, and sometimes maintaining parallel systems to ensure continuity of service. Risk management. Detailed risk assessments and mitigation plans are essential to minimize disruption during implementation. This includes identifying potential risks, developing contingency plans, and conducting thorough testing before full deployment. Phased rollouts. Implementing new technologies in phases allows for gradual integration and minimizes the risk of widespread disruption. Section 2. Security concerns and data breaches. Heightened security concerns. In today's interconnected world, the financial sector faces heightened security concerns and the ever-present threat of data breaches. As institutions leverage technology to enhance services, the complexity and volume of cybersecurity threats have escalated. These concerns are not merely about losing financial data, but have broader implications for customer trust and regulatory compliance. Sensitive information protection. Financial institutions handle sensitive data, including bank account numbers, transaction details, and personal identification data. Protecting this information from unauthorized access and theft is critical to maintaining customer trust and preventing financial fraud. Evolving cyber threats. Cyber criminals continually develop new tactics to exploit vulnerabilities in software, hardware, and human behavior. Financial institutions must stay ahead of these threats by implementing advanced security measures and adopting a proactive approach to cybersecurity. Investing in cybersecurity. To combat these threats, financial institutions invest heavily in cybersecurity measures. This includes advanced encryption technologies to secure data in transit and at rest, robust firewalls to prevent unauthorized access, multi-factor authentication, MFA. Implementing MFA adds additional layers of security by requiring users to verify their identity using multiple credentials. This significantly reduces the risk of unauthorized access, even if one factor, like a password, is compromised. Employee training. Regular training sessions help employees recognize phishing attempts and other common cyber threats. Incident response planning. Having an effective incident response plan is crucial for managing security concerns. Response strategy. An effective incident response plan should include immediate actions to contain and evaluate the breach, communication strategies to inform stakeholders and customers, and remedial actions to prevent future incidents. Regulatory compliance. Laws like GDPR and sector-specific guidelines set stringent requirements for data protection and impose heavy penalties for non-compliance. Section 3. Consumer skepticism and trust issues. Building consumer trust. In the rapidly evolving digital finance landscape, consumer skepticism and trust issues present significant challenges to adopting and growing new financial technologies and services. Personal interactions. Trust forms the foundation of any financial transaction. In traditional banking, trust was built through personal interactions and the physical presence of banks. High-profile breaches. High-profile data breaches and cybersecurity incidents have heightened fears about the safety of personal and financial information online. Addressing skepticism. Financial institutions invest in education and transparency to overcome these trust barriers. Banks can demystify their offerings and build confidence by educating consumers about how digital services work, how their data is protected, and what benefits these services offer. Transparency. Clear, straightforward communication that avoids jargon and is accessible to all levels of financial literacy is crucial. Section 4. Regulatory compliance and costs navigating. Navigating the regulatory compliance landscape presents a significant challenge and a vital obligation for financial institutions. As the financial sector becomes increasingly digitized, maintaining compliance with a complex web of regulations becomes more challenging and costly. Compliance costs. Adhering to laws and regulations set by governmental bodies and monetary authorities involves significant investments in technology, staff training, and administrative overhead. Financial institutions must continuously update systems and processes to stay compliant with changing regulations. Data protection. Rules like GDPR impose strict requirements on handling personal data. Complying with these regulations involves sophisticated data management systems and robust security protocols to protect customer information from breaches. Technological solutions. Despite these challenges, technological innovation offers opportunities to reduce the burden of regulatory compliance. Fintech developments like blockchain technology and artificial intelligence, AI, are beneficial. RegTech. Regulatory technology, RegTech, focuses on developing solutions to make compliance more efficient and effective. RegTech solutions can automate reporting and monitoring transactions, making compliance more streamlined and reducing the likelihood of human error. Section 5. Competition from established banks. Competitive dynamics. The financial system is drastically changing, driven by the rise of fintech startups and the growing adoption of digital banking solutions. However, despite this surge in innovation, established banks still hold a dominant position in the market. Trust and resources. Established banks have built their reputations over decades, earning the trust of millions of customers. They have deep financial resources to invest in technology, marketing, and customer service enhancements to ward off competition. Comprehensive offerings. Large banks provide a one-stop shop for customers' financial needs, including savings accounts, mortgages, loans, investment products, and insurance services. The convenience of having all financial products under one roof is a powerful incentive for customers to stay with their current banks. Agility and innovation. Fintech startups' agility often contrasts with the sometimes cumbersome nature of large established banks. Smaller, more agile companies can often adapt more quickly to new technologies and consumer preferences. Customer-centric focus. Startups tend to focus intensely on user experience and customer service. They use data analytics more effectively to tailor their services to individual needs and preferences, which large banks may struggle to replicate. Technology adoption. Fintech companies leverage cutting-edge technologies like blockchain and cryptocurrencies to offer innovative solutions that meet the evolving demands of digitally savvy customers.